once. I find a lot of people don't want to even talk about a will, because if you talk about your will, it means you're talking about your future demise. And that's not a pleasant thing to do, sitting around in the evening or meeting with somebody, but it's a necessity. And it's something that everyone should do, because if you don't do it, you are not in charge of what happens to everything you worked so hard for your entire life. You're not in charge of where your money goes, your investments, your house, your car, your jewelry. The government will appoint somebody to be the administrator of your estate, and it will get distributed according to legislation, not according to your wishes. So that's a good reason to consider thinking about having a will, or if you already have a will, I will also touch on some ideas about how you might improve your estate plan and change your will. And just to talk about changing a will, if you already have one, it doesn't have to be a huge process. It can be done by a very simple instrument called a codicil. A will can be a wonderful legacy to you. It's a reflection of who you are, who you were, who you're going to become. It's a roadmap to the future for those who you name beneficiaries. It is you taking care of other people, of taking care of your spouse, your children, your grandchildren, relatives, friends, and even institutions and charities like Holy Blossom Temple that you want to benefit. And, I'm not going to spend a lot of time talking about charitable giving, but I'm going to touch on it for one very good reason that I think Daniel is much more qualified to talk about than me. But when you leave a charitable gift in your will, it's one of the best ways to reduce taxes for your estate when you die, and at the same time increase the amount of money available in your estate to be distributed to your beneficiaries. So my understanding, and again, Daniel's the expert on this, but you get a 100% tax credit for gifts to charitable organizations like Holy Blossom Temple. And that certainly increases the available money to leave to your beneficiaries. Also, when you pass away, when your estate sells your investment portfolio, your stocks, your estate pays capital gains tax. If you leave those to an institution like Holy Blossom, then there's no capital gains tax payable by your estate. So that's a good reason to consider a will and consider including charities in your will. But there's some other very good things that you can do with a will. First of all, you get to pick who's going to be the administrator of your estate. That's very important, because you want someone who's responsible, who you can trust, and who will carry out your wishes in a manner that's consistent with what your wishes are. Because again, there are a lot of estates that end up in court because the wrong person is administering that estate. So you have to give careful thought to who is going to be the person that you're going to entrust to look after things when you're no longer with us. And a lot of people who come to our office for estate planning are young people with young children who say now is the time at least to make sure that if anything happens, everything is in place. A lot of other people that come to our office, a bit surprisingly, are elderly people who have no will. Have thought about it for years, have wanted to do it. In fact, I have people that I've got one fellow who's enormously wealthy, who's talked to me for 2 years now about wanting to draw a will, and he still hasn't done it. And I keep encouraging him, come on in, let's have a chat. And he says, yeah, I'm going to do that. And he never shows up. And he wants it, but he just keeps avoiding it. And again, I think it's because the minute you start talking about your will, you're talking about when you're going to die, and who wants to do that? But it's actually a painless process, and most people I can guarantee are going to live for many, many, many more years. So just get it out of the way, put it in your drawer, and it's done. The other thing that you can do with wills that is very significant is that you can look after people that need looking after. There are ways of doing that I think both Jeff and Daniel will talk about. There are trusts that you can set up, testamentary trusts, where you have beneficiaries perhaps you're not so sure can manage an inheritance properly. There are things like insurance trusts that I'm sure Jeff will touch on, hopefully. And there's something called a Henson Trust. If you have a disabled child who's receiving ODSP or government benefits, and all of these things can be very helpful. The other thing that's very helpful with a will is a lot of people designate their children or grandchildren as beneficiaries. And, I remember back when I was a teenager, and one of my friend's fathers passed away when he was 18 years old. And this gentleman was quite wealthy, I suppose. So he had named his son as a major beneficiary of his estate. And his son suddenly got a huge amount of money. Next thing I know, he's driving up the hill to Forest Hill Collegiate in a very expensive sports car and blowing all this money. And by the time he was in his mid-20s, it was all gone. In your will, you can designate the age that somebody receives a bequest. And in fact, what we do often is structure a step up. So at 25, they get a certain percentage. At 30, they get more. When 35, maybe they'll get it all. And also you can create a clause in your will, which we use as a pretty standard clause, that the money set aside for these young people can be used to pay for their education and any other necessities at the discretion of who you name as the trustee of that trust for that child. So there are safeguards that you can build in. You can also name more than one person to be an executor of your will, the estate trustee. So if you have several children and you don't want to just make one of them the person who has that privilege, you can name them to be co-executors. And one other thing I want to mention before I forget is just the notion that you should have powers of attorney. If you don't have those and you haven't done a will and you don't want to do a will right now, please do powers of attorney. If something happens to you, and I'm not talking about something permanent, but you fall ill, you're hospitalized, and you're not in a position to make decisions, not in a position to pay your bills, to look after your affairs. If you designate people as your attorney for personal property, they can do that for you. If you're not able to make medical decisions and you name someone as your attorney for personal care, they can help make medical decisions along with your medical team. So that's very important as well. And I know it's not about a will, but It goes hand in hand with a will. Shira, how am I doing here in terms of, am I at the end? I can't hear you. I'm sorry, you're muted.
We'll wrap it up.
No, that's fine. I can stop right now. You know, I can talk forever, so it's not a problem. So I'll just stop right now.
We'll stop now and we'll move on to Daniel.
Okay. Well, thank you, Shira and Stephen, and good evening to all our attendees. I'm speaking to you as a tax partner on a professional level, and on a personal level, I'm speaking to you as a lifelong member of Holy Blossom Temple who cares deeply about the synagogue. I have the pleasure of serving on the VP of Annual Development and as a member of the Holy Blossom Board of Directors. Since part of my role is looking at financial information, I'm always amazed by the generosity of our congregation. This presentation looks at something that will impact all of us, estate planning. If we take control of our financial affairs, we can redirect funds that would otherwise go to the government in the form of taxes, ensure they go to a charity that will spend the money wisely. Next slide, please. Okay, I'm going to start by covering the basics of taxation at death and then discuss the two types of personal trusts that exist. The final two topics are closely related, so I'll provide you with some background information on graduated rate estates and then discuss charitable giving after death. Next slide, please. Okay, we've all heard the expression that the two certainties in life are death and taxes. From my experience, when these two topics are combined, it can result in a very large tax liability if minimal planning has been completed. Why is that? Well, on death, there is a deemed disposition of all capital property at fair market value. This treats all accrued capital gains as being realized. The main exception to these rules is if property is left to a surviving spouse or common law partner. Now, in that situation, the property is automatically transferred at cost, resulting in no additional tax. As many of you know, the principal residence exemption can be claimed on a home. This can shelter the capital gains tax on this property, which is one of the most generous tax benefits we have in Canada. Capital gains tax will still have to be paid on any other property that you don't designate as a principal residence, such as a cottage or other vacation homes. How about your portfolio investments in private company shares? Well, there'll be capital gains tax on those assets. And as many of you are aware, the 2024 federal budget increased the tax rate for capital gains in excess of $250,000 in a year, starting after June 24th of 2024. For Ontario resident individuals with taxable income over $247,000, the tax rate increased from 26.76 to 35.69%. Now, for many individuals, they can manage to keep their capital gains under $250,000 per year unless there is a sale of real estate or a business. However, all those unrealized capital gains will get triggered at death, which for most people will push them into that 35.69% tax rate category. The fair market value of a registered retirement income fund, or RRIF for short, will be brought into income, which also gets taxed at a high rate. For Ontario resident individuals in the top bracket, that rate is 53.5%. Now, what happens after all the taxes are paid and the capital gains are triggered, the estate or each beneficiary acquires property from the deceased taxpayer at the fair market value at the date of death. Next slide, please. Okay, now at a high level, there's two types of personal trust that can be established. The first type of trust is called an inter vivos trust, and it's set up during an individual's lifetime. Usually the purpose of setting up an inter vivos trust is to transfer the benefit of owning assets to certain individuals, such as children, without actually passing control of these assets to them. A common example is a family trust, which I see frequently with clients that own private companies. An inter vivos trust generally pays tax on all income at the top federal and provincial rate for individuals. The second type of personal trust is called a testamentary trust. This is a trust or estate that is created upon the death of an individual. It is taxed much in the same manner as an inter vivos trust. Now, prior to 2016, testamentary trusts were allowed to access the marginal tax rates that are available to individuals. As a result, there were tax planning strategies that were used to multiply the use of these trusts for estate beneficiaries. I remember, for example, working on a large estate where they had separate testamentary trusts that were set up for each of the 10 grandchildren. So the tax savings would really add up. But like many good tax benefits, this came to an end. Effective January 1st of 2016, testamentary trusts were no longer able to access those graduated tax rates. So in our current environment, the only exception are graduated rate estates and qualified disability trusts. I'm going to discuss graduated rate estates shortly. A qualified disability trust is a testamentary trust established for the benefit of at least one individual who qualifies for the disability tax credit. The main takeaway from this is that testamentary trusts no longer get their own set of marginal tax rates, similar to individuals. Please check your wills, especially if you haven't updated in a while. Check to see if it mentions establishing multiple testamentary trusts. If it does, and the primary reason was for tax purposes, you should revisit this since the benefit has been eliminated. Next slide, please. Okay, on this slide, I've listed the conditions that need to be met to satisfy the definition of a graduated rate estate, or GRE for short. The main points to keep in mind are that a GRE only lasts for 36 months. There can only be one GRE, which must be designated in the trust tax return. A GRE is not a separate trust established in a will. Instead, it arises out of the estate residue at the time of death. CRA has commented that an estate includes all worldwide property owned at death. So another way to view a GRE is it's the estate assets before any allocation to a separate person or trust. In reality, there could be multiple wills with different executors and property located around the world. There must be coordination to ensure that only one estate return gets filed as a GRE. Next slide, please. On the next two slides, I've listed the benefits that are associated with the GRE. This is listed for information purposes only since our time is limited. I encourage you to review these benefits since they apply to anyone who's passed away after 2015 and where the estate assets haven't been distributed. You'll notice that many of the benefits for GREs are the same benefits enjoyed by individuals. I'd like to talk about alternative minimum tax for a moment, since the rules changed on January 1st of this year. Alternative minimum tax is a parallel calculation that can result in additional income taxes if someone is claiming large tax deductions, capital gains, or other items. Starting in 2024, individuals have a $173,000 exemption, whereas GREs get a full exemption from alternative minimum tax. This is a very big benefit for GREs. Next slide, please. I'm going to be addressing points 7 to 9 later in the presentation, so I won't spend any time on this particular slide. So next one, please. Okay. Now, once the 36-month period ends following death, the GRE reverts to a normal testamentary trust. On this slide, I've listed some of the implications on this transition. Unlike the terminal return, where there is a deemed disposition of all property at fair market value, this doesn't happen at the end of the GRE return. Therefore, there won't be any income tax triggered on accrued gains. Instead, you could have an extra filing of a T3 trust return due to the deemed year end and now switching over to a calendar year end date. This will make your accountant happy because there's more filings. As a planning point, it's a good practice to have a clause in the will that allows the executors to use the entire 36-month period to administer the estate. This could save income taxes if the beneficiaries are in a high tax bracket. Next slide, please. Okay, prior to 2016, the tax treatment of charitable gifts made by a will were very restrictive with respect to the tax returns where the donations could be claimed. Now, since 2016, there's been a lot more flexibility for claiming the donation tax credit. Donations made by the will and by the estate are deemed to have been made by the estate at the time the property is transferred to the charity. The estate can then allocate the donation among any of the estate's taxation years in which the donation is made, any earlier year of the estate, or the last 2 taxation years of the deceased individual. I'm sure in at least one of those years, there's going to be a large tax liability that can benefit from that donation tax credit. Estates also have up to 5 years after death to make a gift to a charity. Next slide, please. If a gift is made between 36 and 60 months following death, the estate can carry back the unused donation credits to any prior year in which the estate was a GRE. I'm going to briefly talk about the tax implications of owning private company shares at death. If you have or know someone that owns private company shares, it's critically important that postmortem planning is undertaken right after death. The reason is that there could be 3 levels of tax. First, there's the tax on death, which we discussed because you're deemed to dispose of all your property. Second, there could be tax on the sale of the assets in the corporation. Say you need to get assets liquidated to distribute funds. Third, there could be tax on the distribution from the company in the form of dividends. Remember, anytime you want to take money out of the company and it's not salary, it's going to be dividends. So one of the post-mortem tax planning options available is known as 164(6) loss carryback planning, and it occurs in the first 36 months of the estate. It used to be the first 12 months after death. However, GREs now have 3 years to implement the strategy for deaths on or after August 12, 2024. We're still waiting for this to be receive royal assent, but this is a recent development, so it gives some more time. At a high level, 164(6) planning involves a private company redeeming its shares that are owned by the estate. This creates a deemed dividend and a capital loss to the estate. The capital loss then gets carried back to the terminal return to reduce taxes from the deemed disposition on death. So you're basically, it's like a trade-off. There's going to be some taxes in the estate, but what you're doing is you're taking the loss and you're reducing it on the final return of the deceased individual. Now, if you're redeeming shares in the first 36 months of the estate, you could have a large tax liability from a deemed dividend and very little tax in the terminal return due to the loss carryback. This extension of the donation tax credit to 60 months following death can allow an estate to reduce taxes from the first 36 months of that estate. So the main takeaway here is that there is now a lot of flexibility in claiming donations after death. In many situations, it will make sense to claim them on the final return, but in other situations, it will be beneficial to claim them in the GRE return. Next slide, please. I've listed some planning considerations to take away on this slide. First, make sure that you review your current will to see if it reflects your intentions for planned giving. Stephen alluded to this earlier. Second, the donated property must be property that was owned by the deceased at the date of death or property substituted for that property. You can't use new funds such as a loan or even dividends to fund the donation. This is such an important point, and this is something that I deal with every so often. And if there's assets and you know that there's going to be a donation to a charity to reduce the taxes on the terminal return, you tell everyone involved, do not dispose of those assets. Leave them where they are, because it will preclude you from being able to donate or to claim the donation tax credit against the taxes on death or in the estate. Next slide, please. Okay, so to put this in like an example form, I'm going to use an example of an Ontario resident who passes away on November 30th of this year. On death, the individual had public company shares with a total fair market value of $4.5 million and adjusted cost base of $1.5 million. Therefore, there's going to be a $3 million deemed capital gain. The deceased individual has a RIF with a fair market value of $3 million. In 2024, the deceased individual received CPP and OAS from the government. The estate is considering making a $1 million gift to Holy Blossom Temple. The executor of the estate is not sure if the $1 million donation should be using cash or shares with a fair market value of $1 million and an adjusted cost base of $200,000. Next slide, please. This slide shows the implications under 3 different scenarios. Scenario 1 assumes no donation. So this is kind of your baseline without donating. Scenario 2 assumes a cash donation, and scenario 3 assumes a donation of shares. In scenario 1, the estate has to pay $2.6 million of taxes, which works out to an average tax rate of 52.85%. Pretty hefty. In scenario 2, the estate is able to reduce the taxes payable by $504,000 by making a cash donation of $1 million. In scenario 3, the estate is saving close to $790,000 of taxes by donating shares worth $1 million and with the capital gain of $800,000. In the proof section, you'll see that there's a double tax benefit for scenario 3. First, you get the donation tax credit of $504,000, which is similar to scenario 2. In addition, you are saving $285,000 of taxes by not including the $800,000 capital gain in taxable income. So when you look at the cost of giving to the estate, there is roughly a 50% cost when donating cash. For a $1 million cash donation, this works out to about $496,000 less in after-tax funds available to the estate. When donating $1 million worth of shares and a capital gain of $800,000, which is not going to get included in income, the after-tax cost is only 21%. The estate will have $210,000 less in after-tax cash compared to scenario 1. However, the estate has made a $1 million gift to Holy Blossom Temple. Think of the power that gift can make for the future of the synagogue. I will now pass the presentation over to Jeff.
Thanks, Daniel. Well, since I'm slated to talk to you all about life insurance, I'm almost glad that we're not in person, so no one has an opportunity to throw anything at me. We work with many successful families. Often, to move from success to significance requires a focus on and an intentionality to giving. Most people, to be honest, don't have a giving mission that guides their decision-making framework about what causes, like Holy Blossom, are deserving of their hard-earned capital. After hearing Stephen's remarks, it's probably not surprising because many people don't even have a will, which we would consider, foundational. Giving can be both reactionary or strategic. Both are important and both have their place. Hey, I don't know how many of you are familiar, but next Tuesday, like we have Black Friday, Cyber Monday, next Tuesday is actually Giving Tuesday. So giving is good. We want to encourage it. But we need to spend more time focused on encouraging significant giving opportunities and lowering the cost and stigma to do so. Research shows that people give because of personal and ideological factors, not primarily for tax benefits. That said, the size of gifts, especially meaningful, strategic, and endowed ones, are heavily influenced by the tax benefits received. Following up to what Daniel just showed us, I'm going to actually show you how donating life insurance to charities is often the least expensive and most tax-effective way to create transformational gifts for the causes you care about. When we educate our clients and their professional advisors about the opportunities to create philanthropy using life insurance, they often are naturally confused. It's not your fault, it's not their fault, but ours as an industry for teaching less about what life insurance does than about what life insurance is. So I'll start here by just sharing that, many, if not all of you, will probably be familiar with some very common uses of life insurance. I'm also going to broad stroke the audience and suggest that most of you probably will not be in the camp where you have a young family with a need for income replacement, the way that I do with life insurance. Many people own life insurance to cover debt or a mortgage so that they can provide capital to pay the balance off on their passing. And then a smaller subset, might buy life insurance as an alternate savings vehicle for tax-exempt cash accumulation when they're fortunate enough that their registered investment vehicles are maximized and their taxable accounts are otherwise inefficient for net worth growth. The high net worth and philanthropically minded use life insurance differently. I'm going to give some examples here that some of you might not be familiar with, but it will lead into where I'm going with this. So many will use this as a means for estate tax funding. That's probably the number one, most common and obvious. Others might have a need for estate equalization when different assets, such as an operating business and or property, are to be distributed differently to their heirs. Others might still have a shareholder buy-sell agreement that they use life insurance to fund. Those in a business might actually have an insurance policy on themselves or a key individual to provide that key person coverage replacement value for the business. Some might use it for an executive compensation arrangements. Others are able to take advantage of corporate tax-free capital dividends that the insurance creates. And then this is really the tip of the iceberg are immediate or deferred financing strategies. So, I want to share that there is good news in that many of our mature aged clients are very surprised to learn that they are often actually insurable, even after having experienced health challenges, normal health challenges. This year alone, we've secured excellent insurance approvals for 2 couples in their early to mid 70s and several in their late 60s. For those with substantial resources, insurance planning, even at these ages, can make great financial sense and actually yield equivalent pre-tax investment returns of anywhere from 6 to 10% when compared appropriately. I'm going to just share a resource here from the Canadian Association for Gift Planners while I talk about this. So how do gifts of life insurance work? Some might have an existing policy that they want to donate. For individuals, you would receive a charitable tax receipt for the policy's fair market value, which is usable to mitigate up to 75% of net taxable income payable in the current year or carried forward for the next 5 years. You should note that, and we won't have time to go into all of these details, but fair market value could actually be significantly greater than the policy's cash or exit value, especially if one's health has adversely changed since the policy was first acquired. For those who might own a closely held corporation like a holding company, the owners might wish to donate an existing policy that they bought, again, for one of those purposes that the operational business is no longer a going concern. They don't need an insurance policy necessarily for the same reasons they initially bought it. So the corporate donor would actually receive a deduction against income for up to 100% of the fair market value of the receipt. If any ongoing premium payments are required, which not all charities love, charitable tax receipts will be issued for future premiums paid, or the charity might actually choose to fund these from operating cash flow, depending on their circumstances, or through a third-party separate donor. The most important point that I can make for all of you tonight is if you find yourselves in a position where you own something that you haven't looked at for a long time, please don't let a policy lapse that you no longer need, including term insurance policies that you may have acquired during the family building years where you are no longer in, without first reviewing these options first. Speak to your advisor, speak to your accountant, bring it up with your lawyer, but you will often receive much more than something for the nothing that you otherwise would cancel for. Another route is to donate a new policy. So one would receive charitable tax receipts for ongoing premiums paid if making a charity the owner of the policy, but no receipt would be available to them at death. What someone chooses to do is obviously highly dependent on their circumstances. If they're receiving income in these years, if it's more valuable and strategic to have tax receipts offset current income versus expected estate tax. If you choose instead to continue owning the policy, but wish to make a charity the beneficiary for some or all of the life insurance proceeds, your estate would receive a corresponding tax receipt for the death benefit to offset up to 100% of your terminal taxes on death, including for the year prior. The big secret here, and this applies to Holy Blossom, it applies to a donor advised fund, whatever it is, another private foundation, is that life insurance can be owned and paid for by these entities. It's not just individuals and corporations that can or should own life insurance. I should note that the Canadian Association of Gift Planners, the CAGP, which I'm referencing on this slide here, has a number of excellent resources to guide and educate potential Canadian donors and charities in the mechanics of life insurance gifting, including questions to be asked of one's advisors to ensure that the gift proposal aligns with your understanding of the benefits and risks of such a donation. Obviously, there are inherent biases and conflicts of interest. These always need to be disclosed and well understood by a client. I'm very happy to circulate any of these resources to anyone who might be interested after our talk. I'm just going to flip to a quick example case study here. So first of all, I just want to note, while these numbers are large, please know that they are completely scalable to anyone's individual circumstances. This is not an endorsement of any particular product, numbers, anything like that. This is really just to give an example of two quite different approaches to how one might structure a gift. So I've used as my illustrative example here a 65-year-old couple with deep roots at Holy Blossom, considering making a transformational $1 million gift using life insurance. You might actually want to think back to the slide Daniel just showed where cash or securities are being used as an alternative. It would have been helpful for me to maybe line all of those up here so we could compare all of them. But to give two very different examples of how this gift could be structured. So number one, ultimately an endowed gift of $2.26 million would be fully received on the donor's death. The annual premium of $81,035, which would be made over 10 years, is considered a charitable donation. So our couple's net cost after the charitable donation tax deduction is approximately $40,518. Upon the second of them to pass, which I've projected 25 years into the future, Holy Blossom would receive $2.26 million. What's interesting here is that the net cost to our donors is actually just 18 cents for each dollar donated. That's a very powerful takeaway. And to use that equivalent, for one to give cash, the size of the gift would have to be enormous in comparison. On the other side, there are others who feel like, hey, I would love to make a large gift on my passing, but it's very important actually to give cash or some kind of gift annually to the causes that I care about, because that resonates deeply. It's felt annually. There's actually a way to structure the life insurance. It's a little less valuable on a sort of end of gift sort of magnitude, but it's another flavor. So an endowed gift of $1.55 million could be created, which would include annual cash distributions to Holy Blossom from the insurance policy itself, received tax-free, as well as a large payment of $1 million on death. So the annual premiums are similar in this example, $82,175 over 10 years, also considered a charitable donation. The couple's net cost after the donation tax receipt is received is approximately $41,088. Holy Blossom will receive tax-free cash dividends, which over the couple's lifetime average $22,032 annually for the rest of the donor's life. Upon the second of them to pass, again, 25 years from now, Holy Blossom receives $1 million, and the net cost to our donors in this example is a little bit higher for that opportunity, 26 cents for each dollar donated, 26%. As Daniel showed, the cost of giving could be reduced even further if the donors used appreciated securities to fund that gift. And while we won't have the opportunity tonight to give this proper treatment, some of you may have heard this, may not have heard this, but by using an immediate financing arrangement, or IFA, which is an advanced financial planning strategy for affluent families preferred by many accountants, bankers, and investment counselors, the cost of giving can be reduced even further. For those who want to balance gift making today, either using cash or donated securities, while still leaving a significant family inheritance, could also consider using the tax refund created from the gift of current assets to purchase, for example, an annuity, which can fund insurance premiums. This can guarantee help for the temple today or another cause while replenishing the family wealth. Just, it's a matter of timing. I'm going to wrap up here by just leaving a couple last comments. My well-known colleague, Mark Halpern, refers to people becoming accidental philanthropists as those who leave money to causes, charities, and family instead of the tax department when given the opportunity. So a few categories that would be really valuable, I think, to look out for, within your own, selves, network, etc. Widows, divorcees, and single people don't realize the discrimination, the financial discrimination they face when most of their assets, including RSPs and RIFs, will be taxable at 35 to 50% without a spouse to roll things over to tax-free. There are ways to avoid or at least to minimize these outcomes. Some of them are donating, those assets directly, whether or not life insurance is used to replenish the asset on death. Successful people in general whose money is in motion So think, one selling a business, investment real estate, appreciated securities, or who might have done an estate freeze will often face their largest tax bills in life in those moments. Most don't realize that these taxes can be offset with strategic charitable giving now, while still getting most or all of the donated money back to their families upon death. And lastly, for those who have already generously left a gift in their wills, which is still great, and I would never want to discourage this, there might be better strategies available to amplify one's generosity in a more cost-effective and tax-efficient manner by using some of the strategies we referred to tonight. I thank you for your time, and I look forward to receiving your questions.
Jeff, can you unshare? Oh, great. Thank you so much. Joan is going to say a few words.
Yes. First of all, thank you, Stephen, Daniel, and Jeff, for your informative and frankly intriguing presentations.
Turn your cameras off. Your camera's off.
Oh, 1 sec. Back on. So
Back on.
thank you for those intriguing presentations. And I just have to say, I'm walking away feeling there is so much to learn. We have 2 goals this evening. One is to inform you, which our panel has done so effectively, regarding the reasons for and just some of the mechanics of estate planning, and to explain the link, as our panelists have begun to do, with supporting Holy Blossom. That explanation of supporting Holy Blossom will conclude our evening, but I am sure you will all be glad to know that there is now an opportunity to ask questions of our panel. Shira, would you lead us through the question and answer period?
Thanks. Okay, we have one question in the chat from Amy, who has a question for Daniel. Does AMT apply in the year of death? I didn't think so. That's her question.
No, I believe it doesn't. I'll just double check, but I'm pretty sure it doesn't.
Okay. Phyllis had a question.
Oh, sorry, I pressed it by mistake.
The hand? Okay. Does anybody have any questions?
Yeah, AMT does not apply in the year of death. I just confirmed it. Yeah.
Okay, Bonnie, go ahead.
A general question. I did my will a few years ago, and I did not have confidence in the lawyer who did it, although she charged a lot of money. But I wanted to get my will reviewed by somebody else. I don't know who at this point. I was told that no lawyer will review another lawyer's will, that they have to start over. Does anyone know if that's true?
I'm going to throw this to Stephen Bookman.
I'm sorry, that was my laugh for the day because Bonnie, you know what? That's not at all the case, okay? Any lawyer should be happy to review your will and to advise you on what they think about it. We do that all the time, okay? And it's very, very important that in many instances you get second opinions, and certainly your will is a very important thing. The other thing I just want to point out to everybody, when you said you paid a lot of money for your will, is
Yes.
many law firms use their wills as kind of what we call a loss leader. In other words, like, why should someone pay a fortune and discourage them from doing an estate plan? Sure, if you're doing something very, very complex, setting up complicated trusts, it'll get expensive. Simple will, really. But yes, any lawyer, how do I put this? Decent lawyer should be happy to review your will and either not charge you for doing that or charge you very, very little.
I don't know what you mean. Any lawyer?
Yeah, well, a lawyer who obviously is familiar with estates. They should, I mean, they don't have to take you on, and they don't have to do it, but I'd be shocked that they wouldn't. I have no idea why a lawyer would refuse. We review other lawyers' work all the time in my office because it's just an integral part of what you do as a lawyer.
I chose a lawyer. I was dealing with a corporate firm, and I asked my corporate lawyer for a recommendation, and he gave me obviously the name of someone in his firm. And I don't know if I should be saying this. It made me nervous that she wasn't Jewish. Is that stupid?
Oh, that's okay. You know what? One of the things in fact, I wrote a blog about this many years ago, and I still get feedback from it. One of the most important things for anybody when they go to a professional, and whether it's a lawyer, a doctor, an accountant, life insurance agent, is to feel comfortable with that person, to actually like them and want to deal with them. If you don't like the lawyer you're dealing with, go somewhere else.
Thanks, Stephen.
Thank you.
I have a question in the chat from Devra. How often should a will be revised, and can the legacy amount be reviewed as well based on tax implication? I don't know who takes that.
I mean,
Daniel?
I could take it. Yeah, I mean, what I just tell my clients generally is that they should be reviewing their wills at least every 5 years or so, because life happens, situations change, tax rules change all the time. The last couple of years has been insane. There's been so many tax measures. And in your economic situation, like maybe you have certain securities where you have really large gains and it's a better candidate now for donating. So I strongly encourage regularly reviewing your will and making necessary adjustments.
Great. Bob?
Okay, thank you. So I fit into the last speaker's category of single person and not getting some of the benefits that I know other people get. I'm used to that in lots of ways, tax-wise. So I was trying to discern what you were saying about setting up like insurance policies, life insurance. I generally have never gotten a life insurance policy, but now I'm thinking, is that a way to get savings on the money that I'm going to be leaving to different charities? And also, is the person who sets up all of that part the same person who is my lawyer for the will?
So I think you're talking about a couple of different things, and I think what you want to do is have a lawyer give you an outline of what you need to do, what your next steps are, and then that lawyer is going to bring someone like, for instance, Jeff in to consult with you and to tell you, what he recommends you need and to help you get it. And then the lawyer is going to incorporate all of that into a plan, an estate plan that's going to achieve the purpose that you're looking for. So it's a combination of people. And, I think, I don't know how Jeff works, but I mean, most life insurance agents are happy to talk to people and sell them insurance. They don't charge for consultations, as I don't think Jeff does. I'm sorry if I'm speaking for him. But I mean, that's what they do, and they're happy to help people by recommending life insurance. And again, a lawyer, that's a lawyer's function, is to assist you in achieving the result you want in the most efficient way, both cost-wise and tax-wise, and, get things done quickly and efficiently.
Okay, thank you.
Can I just add one comment, Bob? In consideration of your situation, and this almost goes for everybody. I'm very deliberate and transparent in sharing that when all you have is a hammer, everything looks like a nail, right? And so, there are usually multiple strategies, tools, product planning, whatever, that are available to people to achieve a certain situation or outcome, desired outcome. I think the most important takeaway is that, whether it's you start with your lawyer or you start with your accountant, I mean, I'm a firm believer in working collaboratively as much as possible with the professional team. There's a certain professional in particular that I generally like to bring into these situations, which is really to create, like almost a fee-based plan that helps to guide the strategies and says, here are the different things that you could consider. One of them might be insurance. One of them might be something completely different. You might not need insurance at all. So it's not that, it's the best thing all the time and that it should always be used, but it's good to understand where it fits into the plan and to have, multiple sets of professional eyes so that you also understand, where's the advice coming from? What's it being generated by? And I always want to make those colors, known. So, we have lots of great professionals we work with. If it's something you want assistance, discussing your situation, we can chat later on.
I'm just going to follow up on that. Someone's asked me for the contact information of our speaker. So if it's okay with you, and I'll share your email addresses. Daniel, if there's a different one that you want me to share other than the
Sure,
one that I have.
Oh,
for
yeah,
you.
I'll send you mine.
Send you
my
okay,
professional
so I will
yeah.
share Jeff and Stephen and Daniel's email in the chat in just a minute. Another question is, one of the joint executors resides in the US. Does this pose a problem?
Yes, it definitely does. Daniel, probably you're the best one to answer that comprehensively, but you should not have an executor that lives outside of Canada as far as, and in the US in particular, my experience has been that often the US government finds a way of getting involved, and what I do when I have children who are executors, one is in the US. What I say in the will is that the Canadian resident executor is basically supposed to do everything, while the one in the US, his opinion counts, and he has the right to, to voice an opinion and give direction, but the work is done by the one in Canada. So Daniel again probably knows more about this than me, but that's
no, you're absolutely right. It gets complicated, but like at a high level from a tax perspective, you are concerned where you have like the majority of the trustees, so like executors, if they're in the US, you could be deemed not to be, you could have filing obligations and it may not be a Canadian trust. So at the very least, you want to have a majority of the Canadian executors. You want at least 2/3 or more than 50% in Canada to avoid any negative tax complications and have any potential US or other foreign tax issues.
Does that answer the question? Okay. Another question, could the last speaker, I think this is for Jeff, explain the insurance schedule in more detail to explain the difference in the two programs? Oh, that's Jeff.
Sorry, I was, so I was really just giving an illustrated example. I mean, generally speaking, if there are two people, not necessarily married partners, but typically that's when it's used, then we can usually put an insurance program in place using those two lives, which creates an equivalent single age that the insurance company prices their product from, which is typically anywhere from 30 to 40% less expensive than implementing something on a single life. There are lots of reasons to do one or not do it based on someone's individual needs and wants, but in that example, I was really just showing that generally if two people at 65 are looking to do something like this, they need permanent life insurance. Generally, it's going to be cash value life insurance. It's going to be a program that grows over time. So the longer that they are funding this, but then it becomes eventually self-funding through dividends internally received from the insurance company. There are different ways of structuring these policies and programs where, again, one's designing for maximum long-term growth, which has a different set of requirements. So, 30 years out in the future, we want this to be as large as possible. Here are the factors and considerations that have to be done internally, you know, from me, from a design perspective, to create that outcome. Others might say, and that's why I wanted to give this alternate, which is, you know, again, I like feeling connected to my giving. You know, I want to make annual gifts, and sometimes I don't have the cash on hand to do so, or I don't have securities that I'm looking to do. You can also, there's, you know, none of these are mutually exclusive. So, you know, I encourage all of you to be as generous as possible to the temple. But, you know, if there's another cause that you care about, whether, you know, you're holding back in your will, or, you know, you have a separate arrangement, or you own a donor advised fund in which, like, you can truly distribute to as many causes as you want, with great flexibility. There are so many ways of doing this that, you know, I think to Stephen's point, you know, when you are in the moment of having these conversations, it's really valuable to be asking these questions, and you know, asking to have other eyes, other, you know, ideas at that table to help you understand what's best for your situation. So, you know, again, whether it's insurance, whether it's you know, gifting private company shares, I mean, those are very technical tax you know, questions that require someone not to go it alone, and ideally don't use, you know, don't just talk to your insurance advisor, you know, who yes, often are you know, incentivized to do something. Ideally it's in your best interest, but you want, you know, multiple eyes to make sure that those strategies are being validated and are appropriate. I don't know if that helps.
Jeff, my name's Arnold Englander. I gave that question, but from your remarks, were you indicating that this was a policy on the joint lives and payable on the last to die?
That's right. Yes, Arnold.
Because your schedule certainly didn't indicate that.
Sorry, I had referenced 2 lives at the top. It wasn't very clear, and it wasn't certainly meant to be like representative of I mean, it's based on actual numbers from, you know, a software that I've run, but it wasn't meant to suggest, you know, you have to do it this way. But yes, it was based on 2, you know, 65-year-old lives, male, female, non-smoker, which give a combined age of a male 58. That's what the insurance pricing becomes based on.
And was this a policy where after the first to die, premiums cease?
These are very excellent questions, Arnold. So it was structured as a guaranteed 20 pay policy. I mean, there's reasons I can go into here or later on for people who want to know more of the specifics on the mechanics, but guaranteed after 20 years that no premiums are taken, but set up so that in the first 10 years, it's overfunded. So, and run so that there's almost no circumstances that could arise where any more payments would need to be made after 10 years. If the donors choose instead, you know, hey, we have the cash flow, we like this idea, it's growing, everything's looking good. You know, we like having that opportunity for somebody if they want to, but depending on someone's risk tolerance and their objectives, I mean, there's other structures that we might use that have, you know, more guarantees, which generally comes with the trade-off of less growth. So that was kind of a neat, you know, 65-year-olds, you know, 20 years, we know we can maximum handle that, but with really no circumstance where after 10 years they would be required to put in anything else. There are products, you know, from companies that in that joint last situation where on the first to die, premium cease. You pay a premium. You pay an additional, you know, factor for that program. We're looking at an analysis on a very large estate right now where we're considering that. I'm not generally a big fan of that if you know, the family has other resources, and again, if the policy is structured in such a way that it's really designed for you know, to create that maximum reserve where, you know, there's not a situation we're going to run into where we're going to have that problem, then, you know, that individual is going to reap the benefits of a different structure. I don't like those first paid up policies.
Okay, thanks.
Thanks. Are there any other questions?
Is that your question?
Yeah.
Are you still on?
Are there any other questions? No? Okay, so let me just say that first of all, if you didn't have a chance to write down the email addresses of our speakers, I will be following up on Monday with a speaker, so don't worry if you can't write it down from the chat, you'll have it. And I will now pass this over to Joan Garson for some concluding remarks.
Thank you, Shira. And thank you again, Stephen, Daniel, and Jeff, for this outstanding evening. We all very much appreciate that as volunteers, you made your expertise available to your fellow Temple members, and all of you have offered so generously to continue to be available. Thank you. This was a lot of content, and Shira, thank you for circulating a recording of the program, and thank you for your work and wisdom in planning this program on all of our behalfs. Thank you, Shira, and Mercy, thank you for supporting Shira. This program marks the formal launch of Legacy Outreach at Holy Blossom Temple. Now you know more effectively how to plan your estates, or at least where to go to ask questions about how to plan your estates. I want to take a moment to explain why you should include Holy Blossom Temple in those plans. We have all seen the outstanding ways in which Temple and its clergy are responding to the demands of the current moment. We are seeing around ourselves at Temple the dozens and dozens and dozens of new families, the philanthropy needed to support the welcome of all of those families, and education and programming and worship is provided day by day by day through the annual campaign, sponsorships, and major gifts. And I thank everyone on this screen who is already a donor to Temple. Thank you. We are so lucky. Legacy giving adds a whole new dimension to Temple philanthropy. When you include Temple in your estate plans, you're supporting the future of Temple, the distant future, we all hope, while, as we have learned, obtaining significant personal benefits through tax planning. Many Temple members have already made the decision to include Temple in their estate plans, as, let me share, have my husband David and I. Your commitment to contribute to Temple through your estate builds the resources and the capacity of Temple, but in the long run. It lets you say, we have your back, Holy Blossom, going forward to all those young families and the families yet to join us and the little ones who aren't even born yet. It doesn't make a demand on your capacity today, and it provides benefits to your estate in the future. Steve Bookman and the others have generously offered as a volunteer to meet you one-on-one and respond to your questions, and I hope you will take these generous Temple members up on their willingness to advise you. Shira will be your Temple contact when you're ready to move ahead and include Temple in your plans. As we have heard today, there are many ways to do that for your own estate, and there are many ways in which Temple can help you realize your philanthropic goals. On behalf of the whole congregation, I want to thank every single one of you here tonight for your interest and your time in participating. Thank you for thinking about how this will enable you to expand your support, not only of your families and your family's future, but also of our wonderful congregation. Thank you very much, and good night.
Thank you, everyone. I don't have to say drive carefully. Thanks.
Get all of them. I'll tell you why. Take whatever's in there. You need your limits, your 2 pieces of paper, and then you'll put it back in there. Yeah.
Okay, well,
I was going to ask you, sit down. 3 questions. You ready? Number 1.